Hey, well, it's a few minutes after the hour, so let's get started. We are so excited to see so many of you joining for everybody's favorite topic, tax season and taxes. I want to just introduce myself. Kira, if you want to go to the next slide for us. Great. So I'm Susan Miller-Davis. I'm the Associate Director of the Food Recovery Initiative with Joint Ventures Silicon Valley. The Food Recovery Initiative has a wide range of roles, but one of the main ones that we've been doing in recent years is under contract with the cities and the county in Santa Clara County. We work to implement SB 1383 with respect to edible food. So that means the food donation requirements that have come into state law in the last few years. And among the many things we do in that area, we offer technical assistance to businesses covered by the law, and that includes the webinar like this on taxes today. So really nice to have you all here and excited to share what we've put together for you. Katie, would you like to introduce yourself?
Sure. Thank you, Susan. Hi, I'm Katie Hettinger. I'm a tax principal at GHJ. We are an accounting and advisory firm with locations in Los Angeles, San Jose, Denver, and Buffalo. I'm located out of our Denver office, but I did work in our Los Angeles office for many years before moving to Denver a few years ago. I work primarily on flow-through entities, so a lot of partnerships, S Corps, LLCs, and then the individuals that those flow into. And one of my specialties is actually food and beverage. So I have a lot of food and beverage clients, and our firm in general has a large food and beverage practice as well. So we're excited to be here today, and I'm going to pass it on to my colleague, Nisha.
Thanks, Katie. Hi, everyone. We're glad to be here. Thanks for the opportunity, Susan. I am Nisha Golcha. I help lead the corporate tax practice at GHJ. We focus on a lot of corporate returns, corporate consulting. That's our bread and butter. But we are industry agnostic, and we help different niches and industries. But as Katie mentioned, food and beverage is one of our primary niche, and it goes across tax, audit, and advisory. And both Katie and I, in our respective roles, help support the firm's food and beverage niche. So here we are trying to do some fun with tax planning in the tax season. So we're ready to roll. Over to you, Susan, I guess.
Great, thank you so much. Next slide. So welcome everyone. Just to kind of set the stage for our session today. In terms of questions, we're not going to have the ability to take them live, but we invite everyone to type your questions into the Q&A box, and we will have time at the end of the session to read them out loud and have our tax experts answer them to the best of their ability. So please, anytime during the session that you have a question, pop it into that Q&A box. And I'll let Nisha and Katie speak more to this, but of course, they're not going to be able to provide any specific tax advice to your situation, but hopefully we'll be able to provide a lot of useful context and information about the tax incentives that we're talking about today. There will be a short survey that will pop up at the end. It's just got, I think, 4 or 5 questions that we're asking you to answer. Would really appreciate it if everyone can just take a minute before they log off to do that. And then we are recording this webinar, and it will be posted within, I hope, a week or 2, along with all the resources that we're going to be sharing, some of the web links and documents as well. So we'll be following up with that recording, and it will be posted on the Santa Clara County Food Recovery Program website, which we'll share information about throughout the presentation. Okay, next slide. So just to give everyone an overview, here are the topics that we're planning to cover. We're going to give you guys a little bit of background on just where we see the opportunity overall for, where there's surplus food and how much could be donated. We're going to do a quick overview of the requirements of this relatively new law, SB 1383. Then, of course, we're going to do an overview of what tax deductions and credits are out there related to food donation. We're going to take you through a few sample tax calculations. We're going to try to describe what the benefits of donating food can be, talk about a few special tax situations, and then, as I said, have some time at the end to answer questions. Okay, next slide. Great. So just to give everyone sort of the same shared understanding of how important this is and really why this is a new law in California, this is data drawn from ReFed, which is a national organization that looks at food waste, as well as the U.S. Environmental Protection Agency. So the best estimates are that there are about 74 million tons of surplus food out there every year. This is, I think, based on 2023 data, which is the most recent available. And if you look at it, if you look at the total food supply, roughly 69%, that big loaf on the left, actually gets eaten. And then unfortunately, 31% for a whole bunch of reasons ends up being what we call surplus. So it can't get sold, or it's not at the right place at the right time, or there are supply chain issues. And many of you know all the different reasons, which really vary by industry. And so of that, a significant portion, could be donated. That's the 6% over here, this slice. But of that, only a tiny percent ends up getting donated. So it's really over in this corner that we're working today. Of course, there are lots of other efforts working on how to reduce surplus and how to address the problem overall. And we're really talking about this donatable food section. And then just to put further context, that big number we looked at, about 65% of it comes from businesses and farms. So 35% is residential. So again, there are different solutions about how to address all this surplus food that are different, whether it's in your home or on a farm or in a supermarket or a manufacturing facility or a food service provider, obviously. But collectively, the business community has a lot to contribute to working on this problem. Then just to bring it a little bit closer to home, the Food Recovery Initiative here at Joint Venture has done some of our own local estimates using a lot of the national data and local data. So we think every year there could be as much as 50 million pounds of surplus food every year just here locally, just in Santa Clara County, just from the business sector. And of that, you can see how much of it gets donated. It's around 15 million pounds or so a year. So we're really looking at that gap that really could be used to, create more meals for people in need. And also just, it's worth a whole lot of money. So that's really the problem that we're trying to tackle and support you all in contributing to the solution. And then just to, kind of reiterate, this is the Environmental Protection Agency has what they call the wasted food scale. And the idea is to go from the best, most environmentally friendly solution to the least desirable solution. And so at the very top is preventing in the first place, right? If we can do better inventory management, or we can find other ways to prevent having surplus food in the first place, that's the best. But as you'll see, right behind that comes donation, right? Because the whole goal is to have food get to people who can eat it. Just to recap, and I hope that everyone who's joining on this call has probably heard about SB 1383. It took effect for many businesses in 2022 and for a wider swath of businesses and organizations in 2024. My team at the Food Recovery Initiative and the Santa Clara County Food Recovery Program are at the ready to talk with anyone who has questions about this coming from Santa Clara County. But just to recap, the basic requirements are that any covered edible food generators. That's what they're called under the law. Number one, donate the maximum amount of edible surplus food that might otherwise go to waste. Number two, keep records on site. And number three, submit a food recovery report each year by May 1st. I've put our program website in here. As I said, we'll be following up with all of the links and invite everyone who has questions to contact us, but just want to contextualize how this conversation fits against, what's happening more broadly in California. Okay, let's see. I am now going to pass to, I'm not sure if it's Nisha or Katie who's picking up next, but our tax experts will start chiming in to give you the skinny on the taxes.
I can go. I guess. Thanks for laying the ground, Susan. As you rightly mentioned, the California Senate bill was passed to reduce organic waste and foster social responsibility through improved waste management. The tax deduction is like an icing on the cake. It was passed by the Internal Revenue Code as a tax incentive to encourage business to donate surplus food and get tax benefit out of it. Obviously, the key objective of the bill was to, achieve 75% reduction in organic waste by 2025 relative to the 2014 levels, and also recover at least 20% of currently disposed edible food for human consumption by 2025. Like we talk numbers, all of that comes with a cost. According to California Recycle Department, it's estimated that the direct cost of implementing this bill would be approximately $20.9 billion between 2019 and 2030. It includes infrastructure expansion, collection, processing, and other admin costs. So just to lay the ground that the magnitude of the government is investing on this cause, which both has a social aspect to it, but also a motive to encourage businesses to do it more so that they get benefit out of it too. And the recent current volatile tax landscape around tariffs, funding freeze, and export disruptions, these deductions become even more meaningful to farmers, grocery stores, and food distributors. Katie will cover that later in her slides, on how other people can benefit from them. But on this slide particularly, let me share some cool, fun facts about the taxpayers' tax incentive. These deductions can go as high as twice the cost of the food donated, which is more than any kind of deductions that you will see out there. And the irony is that there's very less awareness around this topic. Eligible entities, when we did our introduction, could include C corporations, S corps, LLCs, partnerships, and sole proprietorships. So it's eligible to all businesses. The government is trying to really make it easy for businesses to go ahead and donate to our cause. The requirement is that the food should be wholesome. The definition of wholesome food is what is intended for human consumption and meets some quality and labeling standards imposed by the federal, state, and local laws. So if you have a doubt, we recommend that you consult your local CPA. It has to be done through an organization that's registered under 501c3. So that's something that a lot of businesses miss, that in order for you to be eligible, you have to go through a charitable organization and get proper documentation, which Katie will go over in the later slides as to what kind of documentation you need for you to be able to donate to a cause, but also get credit for that. It is limited. There is some limitation to it. It's limited to 15%. If you're a C Corp, it's 15% of your taxable income, which starts with your book income and there are tax adjustments and leads to your taxable income. If you are any other type of entities like S Corp, an LLC, or a partnership, it's limited to 15% of your book income. Interestingly, the CARES Act that came into play during COVID increased the deductions to 25% for 2020 and 2021. but we are back to 15% in the post-COVID world. Lastly, on this slide, the carryover period is critical. So if for some reason you're not able to utilize fully the 100% of your deduction in year one, you can actually go and carry it forward for 5 years and have the ability to offset your future taxable income over 5 years. With that, on the next slide, I think it's Katie.
Yep, I'll take that one. Thanks, Nisha. So Nisha went over a lot of these items already, but these are just the IRS requirements on the donation for the food. So one thing is you cannot exchange any property, services, or money for the food. So it must truly be a donation. They don't want anything received in return, of course. You must receive the written documentation from the organization that you're donating to. So that's something that Nisha touched on. The other thing I want to mention is there is a form 8283. It's a tax form. That's where you report non-cash charitable contributions. And you most likely will need to file this form, especially if the donation amount exceeds $5,000. Then you actually need to make sure the nonprofit signs that as well. That's on top of the written documentation you already need, because you actually need to get that signed 8283 attached to the tax return. And depending on the type of entity, if you are a flow-through entity, you'll actually need to attach it to all the shareholder or partner K1s as well. So that's something, I've had clients in the past not really realize that, and now we're getting near to the end, tax deadline. So you want to make sure to get that tied up before, you're too close to your deadlines. So Nisha already mentioned the food must be wholesome, which again is just must meet all labeling and quality standards that are imposed by the federal, state, and local regulations. Must be donated to a qualified charity, 501c3 status. And the recipient organization must be using the food in a manner consistent with their exempt purpose, and it must be used for the care of the ill, needy, infants, or minor children. And then we put the code, the IRC section 170 in there, but if you ever want to read that for fun.
Hey, let's play the number game because what's tax accounts worth if you don't talk numbers. So for you to visualize a deduction, we are sharing an example. Say a restaurant donates 100 pounds of chicken to a food charity. And the total indirect and direct cost for the restaurant is about $3 per pound, which comes to about $300 for the 100-pound chicken. Now, the adjusted tax basis equals your direct cost plus your allocated indirect cost. Direct cost is your cost of buying the chicken. Indirect cost is, it can be creative and can include, among other costs, your utilities or rent to maintain the rental facility. And an allocated portion of that you can, allocate to whatever you spend to run the whole facility. A portion of that can be allocated to the food that you're donating. For more, direction on that, we recommend that you consult a CPA to see what kind of indirect costs you can include to be part of your adjusted tax basis. And if the chicken sells for, say, $10 a pound in the market, that's a fair market value. So in this example, it's $10 per pound, and it's like $1,000, your fair market value. So your expected pre-tax margin is $700, which is your fair market value minus your adjusted tax basis. The eligible deduction is the lesser of your adjusted tax basis, which is a total direct plus allocated indirect cost, plus 50% of your margin, which in our example is $700. So it's a lesser of 300 plus 350, which is 650, or twice your adjusted tax basis, which is your direct and indirect cost, which is $600. So in our example, the smaller the two numbers turns out to be $600. So your eligible deduction in this particular example is $600. So at least you get, you have a potential to get a higher deduction, but at the minimum, you are eligible to twice the cost of twice your direct and indirect cost, which is your adjusted tax basis on your tax deduction. And depending on where you live, we'll go with that in the next example. What does that mean in terms of cash savings? So in the previous example, we went over, what would be your total deduction. And this example kind of focuses on the actual cash tax saving. So continuing the number game, let's, go through a scenario analysis. This example we put together is for C corporation, and Katie will go over another example for flow-through entities. This example assumes that your enhanced tax deduction is equal to 50% of your taxable income, because there are some other tax deductions that come into the play. But for simplicity, we assume it does qualify. So it goes over 3 scenarios. So what happens when you sell, you donate, or you discard the food? So going back to the earlier example, say the 100 pounds of chicken was sold for $1,000 at fair market value, and you have other business income of, say, $2,600. Your total income is $3,600. You get cost deduction for your adjusted tax basis for $300. And this is all you get when you sell, but you're getting money, cash out of your total, the value that you pay for your fair market value. So your income for tax purposes is about $3,300 in this case. Tax at 21% corporate tax rate for corporations is $693. So your after-tax cash is $2,600. This is the best case scenario because you're selling it for a value and you're getting, paying tax on it. But in this situation, you don't get an enhanced tax deduction. But if you had the other 2 options, whether you can donate or discard it, let's talk about that. So using the same example, if you decide to donate the food to an eligible nonprofit organization, in addition to the $300 cost that you have as your ATB, you get an enhanced tax deduction up to double the cost, which in that case was $600. So you get an extra tax deduction of $300. Versus if you had discarded, the same food, you would get 0 tax deduction. So long story short, at 21% tax rate, you get an additional cash back at 21% tax rate of your donated food. And this is just for federal purposes. You get an additional benefit from California as a tax credit, which we will go over in another example. So the takeaway from this slide is that if you decide to sell, you definitely have a cash saving because you get money for the food you sell. But if you're not able to sell it and you have an option to donate or just discard it, if you decide take that extra step to donate, you save 21% straight on your food donated for federal, and plus an additional up to 10% for California. With that, I'll hand it over to Katie to go an example for a flow-through entity.
Thanks, Nisha. So Nisha did the hard work. She went over what the whole example means. So this is really the exact same facts as Nisha just discussed, except in this case, we're going through it for flow-through entities. Again, that's my specialty. And so what we did here is we wanted to just show the difference in kind of tax rate and how it can impact the individual tax holder, the tax shareholders and partners. So right now we're assuming a rate of 29.6%. And where we get that rate from is it's the highest individual tax rate of 37% after a 25% what we call QBI, qualified business income deduction. I'm not going to go into that deduction. That could be a whole other webinar, but most businesses should qualify for that. So that's where we're getting that 29.6. But of course, the rate will ultimately depend on the partner's personal tax situation. It also depends on the partner's itemizing deductions, because charitable contributions that flow through to a partner will be on their itemized deductions on their individual returns. So there's a lot of depends and a lot of, what ifs, but overall, this is the best kind of example to show the impact of, whether you sell, you donate, or you discard the food. Again, similar to Nisha's example, it's just that after-tax cash that changed between our examples because of the tax rate, but you're still getting a greater benefit when you donate because you're getting that extra tax deduction there of $300, where if you discard it, you're only getting to write off the basis of $300. So you're still getting more cash in your pocket if you are donating that food. So. Great. So again, we kind of went over it in the examples, the financial savings and the financial impact. But there's also other impacts and why donation might be better than discarding, right? You're having a community impact. The food's distributing to people in your community, people in need. So you can feel good about that. There's an environmental benefit. Susan touched upon a lot of that in the earlier slides. So we're reducing waste and the costs that are associated with that waste. So and Nisha mentioned there's a lot of uncertain tax landscape. And so this is an opportunity for companies to not only feel good about what they're doing, know they're giving back to their community, but then also get some financial savings as well. So there's benefits on kind of all sides of the board there. Great. And so we know it can be challenging for some companies to properly document, the food's basis cost and fair market value, and how do we do that? So there is an option, there's some safe harbor options for calculating your fair market value or your tax basis. This is only for businesses that do not account for inventory normally and are not required to capitalize their indirect costs. So if you are a part of one of those businesses, you will not be able to use the safe harbor, but if you are, then these are options there. So for the fair market value safe harbor, you can just use the price of a similar item that's being sold. You do want to consider the quality and if it's been degraded. So again, think about, do you need to pull that product a little sooner if you really anticipate you're not going to be able to sell it? That way you can get a higher fair market value. For the basis number, the safe harbor is pretty straightforward. It's just 25% of what that fair market value is. So that option is there for those companies that can qualify.
Hey, this slide goes over general versus enhanced tax deduction. There's also a general tax deduction, which is limited to 50% of the business meals. There are certain criteria that needs to be fulfilled for that to be qualified. But this is only 50% of the cost versus enhanced tax deduction goes as high as double the cost of your original cost. So that's a differentiator. We want to highlight that there's no double dipping. You can't take both. You have to take one or the other. But in certain situations, general deductions may be preferred. We want to just highlight two such situations. Say if your fair market value is less than your adjusted tax basis. Since the enhanced tax deduction is lower of twice your ATB or your cost or your cost plus 50% of your margin, if your margin is negative, it may lower your tax benefit. So in that situation, we recommend that you take the general tax deduction. Also, like for C corporation, the deduction is limited to 15% of your taxable income, which I said earlier includes your book income plus some tax adjustments. And if, say, for a year, you're in a taxable loss position, it will be carried over to future years. But if you're projecting or forecasting losses in the foreseeable future and are not able to utilize that for the next 5 years, you're better off taking a general tax deduction, because even though the benefit is lower, you get 50%, the loss generated to the general tax deduction comes into we call it the net operating losses, and you can carry that loss forward indefinitely. So the differentiator is like if you're projecting losses, you can carry those losses forever under general tax deduction versus an enhanced tax deduction. If you're in losses, you're limited. You can only carry it forward for 5 years.
Great. All right, so we just finished talking about the federal deduction, and now we're going to go into a couple different California tax credits. I'm going to be talking about the food donation credit. Nisha's going to cover the transportation credit. But first, let's talk about what's the difference between a credit and a deduction. So a deduction is an additional expense, and you saw it in those examples. You're lowering your taxable income, reducing that amount, and then your tax is calculated on that taxable income amount. A credit is a dollar for dollar against your tax that's already been calculated. So you have all your income, your expenses, any tax adjustments, you have your taxable income, you calculate the tax, then you can take a credit off of that tax amount. So that's what we're talking about here. And that's a couple things that California actually gives you the benefit of doing that. So there's kind of double benefits here. You get a federal deduction and you can get some California credits. So the first credit is the food donation credit. This credit is a little more stringent on who the eligible taxpayers are that can donate, but it's businesses that grow, raise, harvest, pack, or process the donated items. Retailers are excluded from this particular credit. The amount is 15% of the market price, and there's no cap on that amount. I do want to mention that it is a non-refundable credit. And again, there's two different types of credits, non-refundable and refundable. Refundable would mean if you end up if this brings your tax below zero, you would actually get the cash and can receive it as a refund. Non-refundable credit means you cannot bring your tax below zero, but any unused amount is carried forward for 7 years in this example. So again, if you're foreseeing losses for the foreseeable future, as Nisha mentioned with the deduction, the federal deduction, might be a similar issue here. But again, this one you get 7 years, whereas with the deduction, federal deduction, you only got 5. This is all reported on California Form 3814. It's a pretty straightforward form. If you look at the form, you'll see that it mentions fruits and vegetable credit, because when this first came out, it only applied to fruits and vegetables. But now since they've expanded, and you can see the list of eligible food products here. A couple other things I want to mention is this is for donation to California food banks. And you do need to receive a certificate from the food bank certifying the donation and the items. You don't need to attach that to your return, but it does need to be available to the FTB, to California, upon their request. So if you happen to get audited, they can request that. So you do want to make sure you have that certificate. Something else I want to mention about particularly S corporations. S corporations for California have something called the 1.5% S Corp tax. So you have an extra tax for California on your taxable income. The benefit with this is that you can actually use 1/3 of this credit amount to offset some of the S corporation tax, as well as still pass 100% of the credit through to the shareholders. So again, if you're a flow-through entity, this credit will actually pass through to the partners or shareholders on their K1s. A corporation that would just come directly off. And then the next thing I want to mention, this will go for S Corps or for C Corps. California has an $800 minimum tax. This cannot offset the minimum tax. So California still wants to collect their $800 every year. So it can offset anything above that, but the 800 is the minimum tax, and so it can't offset that. All right, on to the next one.
Thanks, Katie. I know California wants the $800, but they are a little bit more generous, and they also give you not just a tax incentive for the surplus food donation, but also gives you an additional credit for transportation cost. So if you and it's a dollar for dollar tax benefit on your cost incurred, like Katie said. So any cost that you incur in transporting your donated food, you get a 50% of that money back. And there is no cap on it. So you can donate food, not just in your vicinity, but can go kilometers, miles, to go above and beyond to go to donate that. And California will give you 50% of that cost back. It's also more generous in a way that the eligible taxpayers include distributors, sellers of agricultural products, and retailers. Some of the provisions that you'll see for tax incentives are not that lenient on retailers, and they exclude them. But for the transportation cost, even retailers are included. The nonprofit charitable organizations will provide you a certificate who transported the agricultural product. So you need a documentation for you to be eligible to take that credit on your tax return. So make sure that you do that before you file your taxes. With that, there's a form called California 3547. It may be moot point for non-tax people, but if they're tax folks here, they may get excited. So this is where you report it to the FTB to get the additional 50%. With that, we are not going to go over the form because I think that will get too nerdy. So we'll leave that at here. Over to you, Katie, for the next slide.
Great. All right, and this is an example. Again, it's assuming the same facts as we had in our prior examples that Nisha and I discussed earlier, but in this case, we're looking at it from a California standpoint, so California tax, and we're looking at it from the California credit that I spoke about, the food donation credit. The transportation credit, we don't have a separate example for, because again, it just depends on your transportation costs and what goes into there. So in this case, you can see still, obviously, if you're selling the product, that's your goal, right, is to be able to sell it. You're going to have the most after-tax cash there. But if you're unable to sell it, you know, what's the benefit of donating versus discarding? You can see here is you actually get $150 credit in this example, which is 15% of the $1,000 market value. And so your after-tax cash, you're saving straight $150 because it's a credit. You're actually saving that in your cash. So it's still benefit, you know, to donating. You're getting that California credit. And again, if you're getting this California credit, you're probably getting this deduction on the federal side too. So there's kind of a double benefit there and some extra cash savings. So yeah, that's that.
Great. Thank you guys so much. My head is kind of spinning. I'm guessing a lot of other heads are spinning because you guys are pros on this, and it's fabulous information and also a lot to take in. I did just want to highlight that there are a lot of resources out there, and we're going to be putting these in the chat as well. So first and foremost, we are going to be summarizing a lot of this information in kind of a brochure or info sheet that will be available on our website, the sccfoodrecovery.org, within a few weeks. We actually wanted to wait until after this webinar to see what specific questions came up or what people were most interested in learning before we finalize that. And then I've highlighted a number of other resources here. So there's a great brochure that Deloitte prepared a few years ago for Philabundance, which is a food bank in Philadelphia that has a lot of information on the federal tax donation. Harvard Law and Policy Clinic is a great resource. They put together guides on all kinds of policy related to food donation, donor liability, and things of that nature. So they have a tax donation guide. It is from 2013 and they haven't done a lot of updates, but it's got some good background for anyone who really wants to get into it more. We talked already about the fact that the IRS code 170 is kind of what governs all of this at the federal level. And so obviously going and looking at the text of that would be a way to learn more. I also wanted to highlight liability protection for food donors. It's not something that we've touched on here because we're trying to stay focused on taxes, but I just want to make sure everyone in the audience knows that there are multiple layers of liability protection at the federal level and also at the state level. So I think there can be a misunderstanding at times that you're putting yourself at risk if you donate food, and that is not at all the case. The legal system really protects you as long as you're donating in good faith food that you believe to be safe and wholesome. So that's really important to know. And then I've put in the two statute links here for the California food donation, both the donation tax credit and the transportation credit. So as I said, we'll also be following up with these resources for those of you who are not inclined to try to grab them quickly off the chat. But just wanted to show that there's a lot out there, and we're going to be doing our best, as I said, to kind of pull it together and synthesize it for to make it simple for anyone looking to take advantage of this in the info sheet that we'll be putting together. So I think now we are ready to move on to questions. And we do have a few that have cropped up, and I certainly invite anyone who's digesting this to type those questions into the Q&A. It's hard to believe you wouldn't have any because I have a lot myself. But let's see. So a few of the questions that are coming in is what percentage of the donated food value can be taken as a tax write-off? And I know that Katie, one of the slides that you went over might be helpful for this, and we can show that again if it's helpful. But I know we had sort of a rule of thumb as well. So is there any guidance you would say if somebody out there is saying, wow, that's a lot of information, I've got to get my accountant to do all this work to figure it out. How can the audience kind of think about how to gauge how valuable this might be for them?
Yeah. So it was on one of the slides that I mentioned. But again, the rule of thumb, again, because of tax rates, and it can depend on what kind of taxpayer you are and what your individual tax rate. But the rule of thumb is the savings is 20 to 30% of your tax basis. That's kind of the rule of thumb amount. And again, Nisha talked about C Corps, 21%. For me, I use that 29.6% number. So it's really something in there because you're getting a deduction, an extra deduction on that amount. And then that would be your intended tax savings. So the California credit would be different. You're actually getting a full credit for that amount. So that's 15% of whatever the amount is donated of that fair market value. So
Okay, great. Another question that came in, I think, is more specifically about fair market value and how that gets calculated. Maybe if either of you can walk through maybe just some examples to make that come to life, or how different businesses or accountants do figure out what the fair market value would be.
Yeah, I'll take actually SB 1383 surprisingly does not define fair market value. So it's what you have to use what's defined under Internal Revenue Code. And to keep things simple, it's usually a price that you would have received if the food were to be sold in the usual marketplace. So if it's like a packaged food, like whatever the value of that is, would typically be like a fair market value. But if it's not a packaged food and there's no price tag, then we have to evaluate as to what the valuation would have been if a similar product would be sold in the marketplace.
Essentially just a reason. It needs to be something reasonable. Sometimes it's obvious, like Nisha mentioned, if it's a packaged food and you're selling it on a normal basis, you know what that fair market value is. If not, it just needs to be something reasonable. That's kind of what the IRS would look at.
Great. And maybe related to that, we can talk a little bit more. I know it came up in the safe harbor slide, but I think it applies more generally as well. Can we talk a little bit about sort of the strategy of potentially thinking about pulling things sooner to donate them, which seems counterintuitive, right? I think everybody wants to, as we saw in the slides,
Right.
maximize your profit by selling, not by donating or throwing it out. But
Right.
can we talk a little bit about that trade-off and how folks can think about that?
Yeah, exactly. So the fair market value we mentioned in the safe harbor, but in general, you're going to look at what quality the food is in. So if it's degrading in quality and it's kind of an unsold, maybe it's an unsold holiday item as an example, or a misshapen fruit or vegetable, you do need to consider the type of quality in that fair market value calculation or when you're coming into that. But also if it's going down, if you don't want to be donating moldy food or something like that. So that's the concept of maybe kind of planning ahead and looking forward to say, okay, do we really think we're going to sell this, or is this something that we should kind of take off the shelves sooner, knowing we probably aren't going to sell it, so that we have a higher fair market value that we can take a higher deduction on and potentially a higher credit as well for California, right? The higher your fair market value is, the higher your potential deduction could be in that case. Again, especially if you're using that safe harbor, for your basis as well, that basis is 25% of your fair market value. So the higher your fair market value, the higher your basis in that case. So I think is planning, and I think that it can be tough, I think, sometimes for businesses to, you may think you're going to be selling the product and you can't always know, but I think proper planning is the best kind of case scenario.
Great. And I think that segues right into another question that we have, which is more from the perspective of the nonprofit that might be receiving the donations. The question is, what is done to ensure food donation quality and value to ensure it is helpful to the receiving nonprofit? And I'll just chime in here, I guess, a couple thoughts, and Katie and Nisha, if you have more to add, I'd invite that. I would say, following on to what Katie said, there's obviously a benefit potentially, from the financial side for the donor to pull it earlier. And obviously it's something that can benefit the nonprofit, right? If a food product, as it gets closer to the expiration, it's that much more likely to need to be turned around really quickly, which can be very hard, in the charitable food system. So I think it can have a benefit both ways. I will also just note under SB 1383, food charities have every right to decline donations. So they're not under any obligation to accept something that a business decides they want to donate, but the charity says we don't have a need for that, or we don't think it's high enough quality to fit with our operations, right? To make it palatable and safe and nutritious, et cetera, for our audiences. So I think that's kind of the safeguard that's built into the system. It doesn't mean that absolutely every item that a business wants to donate, maybe can be donated in that sense. Is there more that you guys would add to that?
I mean, just to add, oh, I'm sorry, Nisha, did you want to go?
No, go ahead.
Okay. I was going to say, just to add on to that too, that's also why one of the requirements from the IRS is that they have to receive written documentation from the organization, right? So it's not just that, this business wants to donate and they're claiming this donation. They do have to have written documentation from the organization that they've received it, what the items were, so I think that can kind of help with that as well. Nisha, I don't know if you had anything else.
Exactly. It's a due diligence, like, like any other donation. Like if we donate like furnitures, but it has to be coming from, the value of the furniture from a charitable organization that you donated to. And they give you a number because yes, you want to believe that the taxpayers, but it's not just at face value. There's another level of, the nonprofit organization is your stamp that, this is the value. They give you a receipt, and this is what you take to your CPA and that's your validation coupon right there.
That's a great way to put it. I love that. Well, I'm not seeing more questions flooding in. So if there are any more questions out there, this is your moment to ask them. Although I do know that both Katie and Nisha would welcome questions or connection from any of you or follow up, as would the team at Joint Venture. And maybe we can just pop that Q&A slide up again so that we can see the email addresses in case anyone wants to contact us.
And
Yeah.
Katie and I know we also want to add that GHJ also have pretty robust nonprofit niche. And we are happy to also share the contact information of our nonprofit team in case anybody needs help.
Yeah. Or any other questions like you were just talking about, Susan, from the charitable organization standpoint. We do have a lot of nonprofit people that we can get people in touch with if needed.
Wonderful. Great. Well, I'm not seeing any other questions coming in, so I think we may end our session just a few minutes before the top of the hour. And again, thank you so much to Katie and Nisha for joining us and sharing their expertise and knowledge. And thank you all for tuning in. And I wish you a very easeful tax season, I guess is how I'll say it.
Thank you. Thank you so much for having us. This was great.
Thank you, Susan.
Thank you.
Thanks.